The most powerful financial decisions in the world are often made right here in the United States. At the center of this system stands the Federal Reserve, the central bank of the United States. In 1913, the United States created the Federal Reserve to stabilize its financial system. Over the decades, the influence of the Federal Reserve expanded far beyond American borders.
Today, a single decision from the Federal Reserve can move trillions of dollars.
Investors across the globe watch every signal coming from the Federal Reserve.
The Fed's primary tool is simple but powerful: the control of interest rates.
When interest rates rise, borrowing becomes more expensive across the economy.
When borrowing becomes expensive, businesses and consumers slow their spending.
And when spending slows, the entire economy begins to cool down. The Federal Reserve also influences the economy through the U.S. Treasury bond market.
Tense. U.S. Treasury bonds are considered one of the safest assets in global finance.
When the Fed buys bonds, it pushes more money into the financial system.
This policy became especially important after the financial crisis of 2008.
To prevent economic collapse, the Fed introduced an extraordinary policy called quantitative easing.
Through quantitative easing, the Federal Reserve began purchasing massive amounts of financial assets.
These purchases injected liquidity directly into the American financial system.
As liquidity increased, financial markets slowly began to recover.
Investors worldwide quickly realized how powerful the Federal Reserve had become.
Because the Fed was no longer just stabilizing America, it was influencing the world.
As global finance expanded, the influence of the Federal Reserve became impossible to ignore.
The dominance of the US dollar amplified the reach of the Federal Reserve.
Many global commodities, including oil, are priced in US dollars.
As a result, central banks across the world hold large reserves of dollars. This is why decisions made in Washington can ripple through global markets. When the Federal Reserve signals a policy shift, markets around the world begin to react.
Investors analyze every word spoken by the Federal Reserve.
A single interest rate decision can reshape global borrowing costs.
When US bond yields rise, capital often flows back toward the United States.
And that flow of capital can reshape economies far beyond America.
This dynamic has turned the Federal Reserve into one of the most watched institutions in finance.
Every policy meeting has the potential to shift expectations across global markets. Financial media quickly transmit these signals to investors around the world. As the dollar moves, global currencies often follow its direction.
This is the quiet power of monetary policy in the modern financial world.
Yet the real influence of the Federal Reserve becomes most visible during economic shocks.
When uncertainty spreads, investors search for signals from the Federal Reserve.
Because the Fed has the power to inject liquidity into the financial system.
And liquidity often determines whether markets panic or stabilize.
This delicate balance would soon be tested again in the year 2020.
In March 2020, global financial markets experienced one of the fastest crashes in history.
The COVID-19 pandemic suddenly froze economic activity across the United States.
Within days, the Federal Reserve launched emergency measures to support markets.
The central bank cut interest rates back to near zero.
And it began injecting massive liquidity into the financial system. In just a few months, trillions of dollars entered the financial system.
Financial markets began to recover as liquidity returned.
Investors once again followed the direction set by the Federal Reserve.
But the massive stimulus created new challenges for the economy.
By 2021, inflation in the United States began rising rapidly.
By early 2022, inflation in the United States reached levels not seen in decades.
The Federal Reserve responded, raising interest rates aggressively.
As interest rates rose, borrowing costs increased across the global economy. Markets from Europe to Asia reacted to the Federal Reserve's decisions.
This demonstrated how deeply global markets depend on the policies of the Fed.
The Federal Reserve was now tightening financial conditions to slow inflation. As rates increased, investors demanded higher returns on U.S. government bonds. A stronger dollar began to reshape currency markets worldwide. This shift in policy sent shockwaves through global financial systems. Once again, the world was adjusting to the decisions of the Federal Reserve.
The Federal Reserve does not directly control the entire global economy.
But its policies strongly influence the global flow of capital.
When the Fed moves interest rates, financial markets everywhere react.
Investors across continents constantly monitor signals from the Fed.
This is largely because the US dollar remains central to global finance.
Central banks around the world still hold large reserves of US dollars.
And US Treasury bonds remain the benchmark for global interest rates.
This means decisions made by the Fed can influence financial conditions worldwide.
Markets across continents adjust rapidly to signals from the Federal Reserve.
This is the quiet but powerful reach of American monetary policy. But its decisions influence financial systems far beyond American borders. Because in modern finance, money flows through a system centered on the dollar.
And the Federal Reserve sits at the heart of that system.
This is why the world continues to watch the Federal Reserve.